So you're not even pressing on the gas?
Nope. Not at all.
Raise your hands up. Be like, oh, no hands. No hands.
No hands.
No hands.
No hands.
There are two interesting stories that happened in the market today. The first, Tesla. Tesla continues to rally, up today $19, even after the news of Tesla's production delivery numbers last week. I am officially short this stock. I was playing Tesla neutrally and simply rolling up the puts, but now I'm staying put, no pun intended. We are not going to roll up, and we're just going to let this short position play out. The second story is APA, Apache Corporation. APA had a huge rally off the big news that they had magically come across a new oil discovery. The rally from the news appears to be speculation after APA had been hammered down to the teens in 2019 and was one of the decade's worst performing stocks. I don't really try to trade off of news. I just try to trade what's right in front of me. Now what I'm trying to do is just try to create a story out of my positions and my portfolio. Which comes to today's topic, how do we handle market randomness? Solution number one, hold your position in perpetuity.
Hold it? Ha! You'll pull it away and I'll land flat on my back and kill myself.
Markets are random and we can't predict what happens next. Markets can break out higher or they can sell off at any time. But history shows that the passive investor can wait. The passive investor approach, which I think was made popular by Warren Buffett, the passive investor approach is when you hold your position, even through black swan events, and basically wait until your position is profitable again. Since 1950, the S&P 500 has had an upward bias with 53% of trading days closing up and 47% of trading days closing down. So basically, all you gotta do is ignore the fact that your portfolio is down 50% and just trust that your portfolio is gonna be positive again.
The moon!
Now, this is the only strategy I do in my 401k. But if you don't think you'll be satisfied waiting a year or more for your portfolio to be positive again, even after a black swan event, or you don't have the stomach to wait, then maybe the strategy isn't for you. Solution number two, volatility arbitrage. I like the idea of volatility arbitrage because it's theoretically a win-win scenario if you're utilizing positive theta decay. Difficult aspect of volatility arbitrage, however, is hedging your positions to be delta neutral. This is difficult to do unless you have unlimited capital, but it may be the best way to handle market randomness. Volatility arbitrage is when you profit from the change in the volatility of an asset because the price of options is based on the volatility of the asset. And you can look to sell options when the volatility is high and hedge your deltas with stock to make your portfolio delta neutral. A delta neutral portfolio basically is a strategy where you have no risk to the upside or the downside. And because option prices are dynamic and stock prices move randomly, it is extremely difficult for the retail investor to implement a delta neutral portfolio. Unless, of course, you're running a hedge fund and you have super deep pockets. So basically with the volatility arbitrage strategy, you're trying to collect theta and you're letting the premium come out of those options, and then you're hedging to make sure that the price of the stock or underlying does not affect your position. So solution number three is kind of like solution number one, where if you're selling options, you can roll your positions out to the next month and in essence buy yourself more time, all while collecting more premium, which we like to do. So what I do for my account as a premium seller, meaning I'm always short options, is manage my deltas. I don't want my deltas to get too big, so what I have to do is adjust my positions by rolling up the puts or rolling down the calls, thus reducing my risk to one side. Rolling out gives you more time to be right and reduces your delta. These are all examples of how you could handle market randomness. But in order to handle extreme moves, it's important to understand your risk, which is something that I wish that I understood at a much deeper level when I first started trading. Staying small is the key strategy for me against black swan events.
Shut up!
You're killing me, Smalls.
The last thing you want is for one position to take out your entire portfolio or all of your gains. Diversification is also an important aspect of staying small, because even if you have 20 or 30 small positions, and if those positions are all similar, if one gets affected, then the likelihood of all of them getting affected is higher. For example, have positions in different equity sectors. Trade other products like commodities, financials, energy, and currencies. Also, I think it's important to also trade different strategies and look for opportunities in both sides of the market. Thanks for watching. If you want me to make any more videos like this, make sure to let me know by hitting the like button. Also, let me know in the comment section about how you manage your risk. Peace.